All right, why don't we get started? So thank you very much for joining. So this is the first of two webinars today. Got one at 6 o'clock Sydney time this evening as well on our ETF model portfolios. And I do think they kind of build on each other. So we're going to talk about goals today, which are obviously really important if you're going to go select investments. So today or this evening, we'll talk about selecting investments. But let's get started. So before I get into everything, of course, everything you hear today is general advice. I don't know anything about you. I can't offer personal advice, but questions are always helpful for me and hopefully helpful for you. So if you have any questions, send them through in the chat or the Q&A, and I'll pick them up as we go along. But we do have a lot to cover today, so we'll just get into this. So we're going to talk about goals, why it's important to define goals. And I'll obviously admit that this is sort of the part that a lot of investors like to skip. All right, everyone thinks it's sort of the way that things are portrayed to us that investing is about picking investments. And while that is a step, obviously, in the process, if you skip to that end step and you don't know what you're trying to accomplish, it's probably going to come back and hurt you in the long run because, one, you won't know if you're anywhere close to your goal. You won't know how to track progress against your goal if you don't have one. And then also, if we're just always focused on the investments, it makes it more likely that we're going to spend all our time churning our portfolio, buying new investments. Every time something doesn't do well for a short amount of time, going out, getting something new, and that is not a good way to achieve your investing goals. All right, so let's start out. Why do we define goals? So pretty simple here. Anytime you are trying to accomplish something, it's good to know what you're trying to accomplish. That allows you to take those steps along the way. But when we're talking about investing, really there's two different approaches that we can take as investors, and it is risk capacity and risk tolerance. So anytime you invest, of course, you are taking on risk, and the reward for taking on risk is returns. So ideally, you should get higher returns for the more risk you take on. Now, risk is defined by the investment industry as volatility, how much your portfolio is going to bounce around. And for some investors, that's a really important measure of risk. But I would argue for most investors, that probably is not the risk that you are actually facing. And a perfect example is any investor who has a long time horizon before they need that investment. So let's say you want to retire in 20 years. Do you really care how much your portfolio bounces around and what level it's at 5 years from now? Well, you shouldn't. Because ultimately what you're trying to do is over that long time period is hit that retirement number that you need to have the retirement that you hope to have. And because the investment industry focuses on volatility as the risk, they often look at risk tolerance. So risk tolerance, and you'll see this a lot. You'll see it a lot in a lot of articles that are talking about investing. You'll certainly see it with some financial advisors you go to. They'll have you take a risk tolerance questionnaire. And basically, it will just say to you, okay, what would happen? It'll run through some scenarios. What would happen if your portfolio went down by 20%? Would you jump off a bridge? Would you sell everything and go hide under your bridge, hide under your bed, not hide under the bridge? What would you actually react to that? And the problem, of course, with that is that no part of that risk tolerance questionnaire, unless it's done by someone who's focused more on risk capacity, is somebody telling you how much risk you need to take on. So very simply, stocks bounce around more in value than cash. Now, maybe that's something very, very difficult for you to wrap your head around, that you could go on, and as we're seeing in markets right now, you could log into your online brokerage account and see that your portfolio is down. Maybe that's something that seems really intolerable to you. But if you frame that slightly differently and say, okay, if you just leave your money in cash, you will never be able to retire. Well, then, of course, it reframes that thinking. And that's really risk capacity. How much risk should you take on? How much risk do you need to take on in order to achieve your goals? So there's all sorts of, and I could spend a lot of time talking about why risk tolerance doesn't work when done in isolation. But really what we want to do is frame this around goals. What am I trying to accomplish and how much risk do I need to take on to accomplish that goal? And that can work both ways, right? It can also work with some people that are taking on way too much risk in terms of what their goals are. So maybe you've amassed a lot of money and you're still mostly in equities and you could actually just live off of cash. Well, maybe you might want to turn down that risk that you're taking on as well. So that's why we're defining goals. Without knowing what we want to accomplish and without specifically knowing what we want to accomplish, it's very hard for us to figure out how much risk we need to take on, which means it's really difficult for us to come up with things like asset allocation, which makes it impossible for us to select securities if we don't know what we want that portfolio to look like. All right, so how do you define goals? Well, you actually have to get specific, and people don't like doing this, and they don't like doing it for a couple reasons. One, it's fun to go select investments, but nobody wants to sit there and actually think about their future in a concrete way. Two, because it's hard, and people think it's very hard and it's very difficult to come up with precise estimates around goals. But of course, you don't need to be precise, and you can change your goal at any time. But going through this process, make sure that that change will actually make some sense. That if you decide that, okay, I now want to retire in a cheaper location, I need less money. Well, having that original goal in place will allow you to go through those steps and provide some structure to the process. And we always want to provide structure. As much as I personally hate structure, we always want to provide structure when we're investing because it will hopefully cut out some of those behavioral issues that we have and those mistakes that we make as investors, like reacting emotionally to what's happening in markets. Okay, so how do you define a goal? Well, the first thing you need to figure out is how much your goal will cost. Now, this one is another one where a lot of investors will say to me, well, my goal is to be rich, or my goal is to have as much money as possible. And I think ultimately, maybe that's all of our goals, to have as much money as possible. But there's nothing about this goal setting process that is going to change that outcome. Setting goals does not mean that they can't be exceeded. But going through this process, of course, will allow you to figure out, okay, what's actually realistic. So estimate how much your goal will cost. This, of course, can be hard. If you're estimating for retirement, it's 30 years away. But once again, we can course correct along the way. And remember inflation. So, I think when I gave these presentations, when there was no inflation, that was probably a reminder that people actually needed. Now, of course, inflation is probably something that, a lot more people are thinking about. But yeah, you want to remember inflation. When do you want to achieve your goal? So another thing that I get from a lot of people is they'll make statements like, oh, I'll never retire. I'll just keep working. And maybe they love their jobs. Maybe they're just scared to go through this process and think about what retirement would entail. But once again, this does not mean that you all of a sudden, because you decide you want to retire at 60 with your goal, you have to actually quit at 60. But we do need a time frame. So it's really important. Once again, it can be an estimate, but we do need this time frame as well. This one's pretty simple. Have you saved anything for your goal? So if we're looking at retirement, is there anything in your super balance right now? That's important. And then, of course, how much do you think you can save in the future for your goal? Now, you might be sitting there looking at, why do we have to come up with these four different definitions in order to come up with a goal? And it's simple because we're actually going to use some math. And don't be scared, of course, by the math, but we're going to use some math, and these are the inputs into the formula. That's why we want to try to get at least a good estimate for each one of these four items. All right, so we're going to do an example. So I want to retire with a portfolio worth $1.7 million in today's dollars, and we can add inflation on, which we will, in today's dollars. So, all right, when do I want to retire? In 20 years. What do I have now? Well, I've got $450,000 in my super. How much can I save? Well, I'll just save the mandatory contributions or the compulsory contributions in the super. So I'll save 10% of my $100,000 salary. All right. So that wasn't too hard, right? Obviously, that retirement one is a little trickier. If anyone wants some tips on how to calculate how much you need for retirement, send me an email. I'll send you an article on that that outlines how to do that. But we've got all of the elements here, right? We have $1.7 million. Remember, in today's dollars, we'll add in inflation. We've got a time frame, 20 years. We know how much we have saved already, and we know how much we will save in the future. So there we go. So first thing we need to do, as I said, we need to take inflation into account. So why do we do this? Well, of course, with any goal, what are you doing? You're sacrificing today to spend money in the future. We need to know how much those dollars are worth. Because really, when you're coming up with a goal like retirement, most people think about lifestyle. And the easiest way to think about lifestyle is not to add up every little thing that you spend money on, but think about, okay, right now, am I living the life that I want to live in retirement with my salary? If I am, then there we go. We can figure out the lifestyle we want, and then we can take what we're spending today, and we can, of course, translate that into the future. So CPI is obviously the way that we measure inflation as a country globally, as we measure inflation. So the way CPI works, most people do know this, but a basket of goods that's supposed to represent the average consumer in Australia is created. And then, of course, price changes in that basket of goods is measured. And that's great. It's a good way for the government to measure inflation. But that, of course, does not represent your life. And so I went in and just put in CPI, what everyone allocates to different categories. And you can very easily see that there's a lot of things on here that could be very different about your life, and potentially could be very different about your life in retirement, especially this housing cost right here, right? So this housing cost, of course, is made up of people who have mortgages, people that are renting, but a third of the houses in Australia are owned outright by the owner. So CPI could come down for you if you don't actually have to pay more housing costs. And one of the big drivers, of course, of inflation now, we've seen very large increases, and of course, mortgages as interest rates have gone up, and then rental properties as well. So just make sure that you come up with an estimate that's actually reflective of you and in your own life. So that's an important thing to do. All right, so let's get back into why we picked all four of these elements. We want to calculate a required rate of return. So very simply, a required rate of return, and what we've done here is we've translated this $1.7 million, I think we increased it by 2.6% a year, to future dollars, what we need, 2.84 million. All right, so that's what we need in 20 years. Got our current balance, and we're saving $10,000 every year, all right? The required rate of return is simply with those savings goals, with what you have, when you want to retire and what you need to retire, what is the return that your portfolio needs to generate? What your investments need to generate in order to reach that goal? Now, this is a really, really important number. And it's a really important number because, one, it will tell you right off the bat, which we'll get into in a second, it will tell you if your goal is realistic. So if you have a rate of return that is very high, and we'll use an extreme example, if you go through this exercise and you need a 20% rate of return in order to achieve your goals, guess what? You're probably not going to get there. And so what that means is it's back to the drawing board. And obviously that gives us the ability, if we do this, to course correct. So one thing you could do here in this example, you could save more money. All right, so very simply, I could put in some additional contributions into super, other than the compulsory contribution. I could delay retirement. I could say, okay, well, I need 5 more years. I could potentially cut back on what I want from a retirement. Maybe I'm going to think about moving to a cheaper location. Maybe I'm going to think about selling my house and buying a cheaper house that's smaller. So all sorts of things you can do, but rather than burying our heads and not going through this exercise, we do want to be informed. And that's what we're getting from that required rate of return. So what I did is I just plugged this into, we do have a goal scenario as part of Morningstar Investor, but you can do this with any sort of financial calculator. So you can find a financial calculator online, just Google it. It's a little trickier, I think, than our goal calculator, just because some of the terms might be a little confusing that are used in a lot of these investment calculators. But yeah, very simply, $450,000. I want 1.7 million in the future. I am adding in inflation, so 2.6% a year. It's telling me what that inflated future value is. And every year I'm saving 10%. I want this in 20 years. So I got a number, 8.6%. All right. As I said, this is an important number. The first thing I sit there and I look at that and I say, okay, well, 8.6% seems reasonable to achieve given long-term market returns. However, that 8.6% is also going to inform the way that we invest. So back in that example I used earlier, somebody that takes that risk tolerance questionnaire and says, oh, no, I'm actually scared of my portfolio bouncing around in value. I'd rather keep my money in cash. Well, guess what? Even though interest rates have gone up, you are not getting 8.6% over the long term from cash. So that can help frame the risk that you need to take on. You need to invest in growth assets in order to get that 8.6%. So a important number. So, yep. As I said before, we need to assess the feasibility of our goal. One thing I didn't mention that is important is, of course, we are looking at returns after fees. In this case, we're taking inflation into account, but if you don't take inflation into account, remember, then we need a real rate of return on top of inflation. And a lot of people don't report these numbers, right? So certainly not inflation. Anytime you go to an ETF and it tells you incorporate fees, but it tells you, the return it's had over the last 20 years, that does not include inflation. Right? So that always lowers returns. We're looking for real returns on top of inflation. And that's why we want to take inflation into account. Now, we've already done that in this situation. So we don't necessarily have to worry about inflation, but we do have to think about fees and fees holistically. So everything that you're paying and taxes. Taxes are really important. If it's in super, obviously, depending upon the approach, if you're not selling anything until your pension phase, you won't have to pay taxes. But if you're sort of constantly trading your portfolio, you're still going to pay taxes on any income you receive and any capital gains that you generate. So just something important to think about. All right. As I said, this is going to be an input into your asset allocation. So I will get to that in 1 second. I'll save that question. So thank you for the question, Colin. I will get there. All right. So how do we then use this as an input that gets us into the proper asset allocation? Now, asset allocation is simply how you allocate your portfolio into different buckets. And we'll talk about the levels of those buckets. So, and this will really get into that ETF webinar we're doing at 6 p.m. tonight. At a high level, we have growth assets and we have defensive assets. So defensive assets, bonds, cash. Growth assets, shares, listed property, infrastructure. So as you can imagine, growth assets bounce around in value more, but over the long term, they have higher expected returns and higher historic returns. Defensive assets, the opposite. They tend to bounce around less in value, but the returns you get are lower. So we want an 8.6% return. Now, obviously, the caveat here is that historical returns may not occur in the future. But if we go back and we look at the past 30 years, we can see the returns of different asset classes. And this is why if we sit there and look at this, that, okay, that 8.6% return is fairly feasible, right? US shares have outperformed that. Aussie shares have outperformed that. That's, of course, without franking credits. Aussie listed properties outperform that. International shares, I think that's international. Oh, international shares, not just the US, slightly underperformed it. But cash, of course, fell way short. So this is where we can start thinking about, okay, what is the return that is actually feasible and where should I position my portfolio? Now, asset allocation, of course, can get very complicated in terms of starting to put in small cap shares and emerging market shares and everything else. But at a high level, we want to make sure that that growth and defensive alignment of a portfolio has a chance of achieving your returns. Because if you don't do that, and asset allocation is a huge driver of overall returns. But if you don't do that, then you are never going to actually achieve your goals. And this is why we want to go through that process. And yes, I have a little caveat. The return environment over the last 30 years was extremely favorable. And we will see, of course, what happens in the future. But at least this is a good first step to take. All right. I kind of went through this before, so I'll do it very quickly. What do you do if your goal is unrealistic? Well, of course, you make all those adjustments. And remember that this is just a formula. And I think intuitively, it's a time value of money formula. It's kind of rearranged to calculate that required rate of return. Intuitively, I think most people get this, but I'll go through it quickly. Once again, so let's say in this situation, we say, we don't think we can get 8.6% return. We think a 7.5% return is actually achievable. Well, there's a couple levers we can pull. I said retire later. So that's an option. So how do you get that required rate of return lower? Well, you can retire 4 years later. Maybe that's something that's tolerable to you. Maybe it isn't. You can increase your savings. Now, you have to increase your savings by a lot, but obviously the more money you save, the more money you'll have in the future. So this would be more than doubling your savings. So maybe that's completely unfeasible for you, but there we go. We could reduce our goal. So in this case, 2.84 million, including inflation, we could drop that goal by $500,000. Now, maybe that's feasible. Or I guess it's feasible, it's definitely feasible. But maybe that's something that's tolerable to you. You would rather work longer to get that lifestyle you want in retirement. Maybe you sit there and say, hey, I really don't want to work anymore. I'd rather have less of a lifestyle. So you can reduce the goal by $500,000. But of course, the other thing you can do is screw around with each one of these. Maybe you delay your retirement by 2 years. Maybe you increase your savings to $15,000. All that stuff you can do in that goal calculator, and all that stuff you can do with any sort of financial calculator you find online to go through and adjust those different inputs into how much money you are going to have in the future. So I'll pause for a second and answer some questions. Okay, so we've got a question. Peter says, are you able to provide your presentation by email? Yes, but you have to email me for it because I don't know your email. So if you email me at mark.lamonica1@morningstar.com, I will send across the presentation. So we've got a question from Mark. I obviously like your name, Mark, but he says, can you change the thinking from bucket of assets goal to an income per year goal? How do they interrelate with thinking about that? It's a really, really good question. When we are calculating how much we need for retirement, if anyone wants the article, email me. I kind of outline the steps. But typically the way that we do this is we don't focus on a bucket of assets. We focus on what you want to take out of your portfolio every year, right? Because that's, of course, how we've been trained to think. You work, you have a salary, you need to fit your budget into that salary. It's very difficult for anyone to sit there and say that I want a retirement where I have $2.8 million, right? The way that people generally think is, okay, how much money do I want to spend every year? I want to spend $40,000 a year. That's what I want to be able to take out of my portfolio every year to spend on my life. So the way that we make those two numbers work is we simply divide how much money you want per year from your portfolio by a withdrawal rate. So 4% is always kind of the classic withdrawal rate, the safe withdrawal rate, so that you don't run out of money. when you're retired, right? Without knowing when that end is, and without knowing not knowing what market returns are. That makes it difficult. That's why we want a safe withdrawal rate. If you're looking to generate income from your portfolio, and I got this question a couple of weeks ago and wrote an article on it where somebody said, hey, everyone says 4%, but the Aussie market's actually yielding more than 40% in dividend payments, and you get franking credits. So why wouldn't I just generate income from a smaller portfolio? And that's completely fair too. In that case, what you'd want to do is, if your goal is to generate that amount of income, you can start tracking against income. That could be your goal that you set. I want $40,000 a year in income to be generated by my portfolio. And we can make some assumptions around what your portfolio will yield and sort of the approach that you want to take doing that. So hopefully that answered your questions, Mark. But that's how we link those two things up. We do think about how much we want to take out of our portfolio every year. So hopefully that helped. So Colin says we have $550,000 in SMSF. Want to retire in 7 years. We're on disability pension, so can't contribute, but reinvest dividends. We're investing in ETFs, IVV. Yep. Where you put those dividends. Yeah. So, kind of classically, what you can do then is, remember, dividends are part of return. So when I say 8.6% return, that includes, of course, capital appreciation, so share prices, or in this case, ETF prices going up, and it also includes dividends, right? And depending upon how you look at the market, you may or may not get those dividends. But really what you want to look at in that case is, okay, what's realistic over the next 7 years for that portfolio to grow to. And since you are closer to retirement, then you can start thinking, okay, what is retirement actually going to look like? So yeah, and then you want to tune in tonight. We'll be talking at least some of those ETFs. All right. So any more questions, just drop them in there. The other reason why we want to set a goal and why we want to calculate that required rate of return, your goal return per year in your portfolio, is not just around asset allocation, which will lead into security selection, but also because it allows you to then track progress against what you're trying to achieve. Now, here's the problem that a lot of people run into when they're looking at quote unquote progress of their portfolio. So people do a couple different things. They will benchmark, they will use a benchmark for their portfolio. And I understand why people do that. And a benchmark, of course, is an index. And I understand why people do that. That's what professional investors do. But remember, you're not a professional investor. So basically what people do is they'll sit there and they'll say, okay, let's say they're an active investor. Let's say they're going out there and buying individual shares, or they're going out there and they are making decisions on individual ETFs to purchase, which really is giving you a different asset allocation than the market. So a lot of people sit there and say, okay, well, I'm going to check my portfolio against, let's say, the ASX 200. And I get why people do this, right? So if you're going out there and making some of these decisions, you could say, well, the ASX 200 went up 10%. My portfolio went up 5%. Like, that's not very good. And yeah, it's not very good. But remember, that's a 1 year period. That's a pretty short timeline. But the problem is that it's hard to find a benchmark that you can use for a well-diversified portfolio. So if you have 40% of your portfolio in global shares, you've got another 10% in bonds, and you've invested in listed property, tracking it against the ASX 200 is not going to be helpful. It's going to send you potentially false signals. All right. So for a while now, basically since the GFC, for example, the US market has significantly outperformed the Australian market. So if you're sitting there with your 40% invested overseas and you're beating the Australian market, what is that actually telling you? Are you a genius? Well, I don't know, maybe you decided that global markets would outperform. But it's not really telling you anything actionable. But what people tend to do is they will make adjustments off of that when really what they're tracking doesn't make any sense. And that once again leads to people kind of panicking and chasing performance, which is not a great thing. But you can track your performance against your goals. So if you're sitting there at the end of the year and your portfolio has returned 10% and your goal is 8.6%, well, that's really good, right? So you are ahead of the game with your goals. So framing it around goals makes it a little bit easier for you to track progress against your actual goal, not some benchmark that really has nothing to do with what you're trying to accomplish, both the way you're investing and what you're trying to accomplish. The other thing is most people have a longer term orientation than a fund manager. So one of the problems and the constraints that professional investors have is that because we tend to move our money around, if some investment doesn't do very well for very short amounts of time, they are very focused on not underperforming significantly because they know a bunch of money will flow out of those investments. They, of course, don't want that because that's how their company makes money, and that's probably how they're compensated as well. So remember, you have a longer time frame, and you don't need to react to short-term performance. I don't know what it says, under. Don't overreact. God knows what's wrong with me because I typed that. Don't overreact to short-term performance. So remember that over these long periods of time, there are going to be years that you are going to get a return that's lower than your goal. Hopefully, it can be years where it's higher than your goal and they'll average out. But the key is not overreacting and making sure that, once again, any changes you make in portfolio, you're doing it for a reason. And that, once again, it's connected to your goal, what you want to achieve, how you want to achieve it, and that asset allocation you want. None of the returns we get include taxes. Some include fees. Fees within that ETF, for example, wouldn't count for those SMSF fees that you're paying, and don't count transaction costs. So we do need to put those returns in context. Remember, what matters to us is how much money is in our bank account. And you see this a lot with professional investors that churn the portfolios a lot that they manage. Well, this could lead to very bad tax outcomes for the investors, but they don't really care because nobody measures, because you can't, nobody measures returns after tax. But it matters to you because, of course, it matters how much money you actually have. So just remember that we do want to focus on inflation. We want to focus on taxes, fees we're paying, the transaction costs to trade in and out, because all of that will directly affect how much money you have. Yeah, Leon said that it also needs to be after tax return. When you are in pension mode, so a question from Edward, when you are in pension phase, you still generate income from your portfolio. How is that included in the calculations? All right, so I believe I know what you're asking, but if not, correct me, please. All right, so of course, when you're in pension phase, it's great because you're not paying taxes. If you have less than $3 million. When you're in pension phase, so yeah, there's some advantages. You're not going to have capital gains taxes or any income tax. So how would you include that in a return? Well, remember, the return that your portfolio is earning includes both income and capital appreciation of those assets. So really what you want to do, and wherever your broker will do this, if you use Sharesight, you can certainly do this. You can still calculate what that return is every single year. Now, the problem is that instead of putting money into your portfolio, you're of course pulling money out of your portfolio. But remember, that's not really going to impact if you are doing the calculations, right? That shouldn't impact the return that your portfolio is generating. So that withdrawal is a withdrawal, right? Just like with a managed fund, when they're calculating performance, doesn't matter if money comes in or money goes out. That's not included in that calculation. I think the other thing that you really need to worry about, of course, is how much you are taking out. And that's, of course, that withdrawal rate. Now, that can be dictated, of course, by the government based on your age. They tell you how much money you need to take out of super, but you don't have to spend that money. So remember, we're really worried about spending there and making sure that the assumption that you made when you're retired, whatever that withdrawal rate is, that you are matching that. So that was a long-winded way of hopefully answering your question. But yeah, let me know, Edward, if I missed anything. All right, I said we had a lot to get through, but apparently we just did that very quickly, which is, I guess, good for all of us. So if there aren't any other questions, I guess I'm going to stop this now. But if anyone does have any questions, if they want this presentation, questions around retirement and how to calculate retirement, just shoot me an email, mark.lamonica1@morningstar.com, and I will send that back to you. And of course, if anyone's interested in doing this all again with a different presentation, talking about ETF model portfolios, then tune in tonight. Oh, so Rod says, how might you consider a windfall such as an inheritance? Okay. The hard part about an inheritance is, and maybe you have a very different situation. The hard part about an inheritance, of course, is most people don't know the timing of when they're going to get it or how much they're going to get. Now, maybe that's different in your particular situation. If you don't know those things, it becomes very, very difficult to incorporate that into your financial plan. And I know that a lot of people's financial plan is, my parents will die and they'll give me money. That's great. There are lots of examples, of course, as people live longer and longer and spend more and more money. It means it's getting later and later till you get that inheritance, and it's getting less and less as they spend money. I would be pretty conservative about the way you're going to do that. But if you are using an inheritance, what I would do is, in terms of that time value of money formula, is it's just a separate bucket, right? So you can sit there and say, very simply, I think I need $1.5 million for retirement. I'm pretty sure that I will be given $500,000 as an inheritance before I retire. All right, you focus on the $1 million. How can you save and invest to get that $1 million? Now, remember, the timing of that $500,000 really matters, because if you get it 15 years before you're going to retire, well, that's awesome. You can add that to your portfolio and hopefully grow that. If you get it a day before you retire, that's still nice. You've gotten this money, but of course, you're not going to be able to grow that money for retirement. So yeah, it's really thinking about that timing. But if you keep it in a separate bucket, just like if you were going to get the age pension, if you were to get, if you had an annuity you bought, you would just take that out of the money that your portfolio needs to generate. So I think that's the best approach that I would do with that. And then, of course, yeah, the timing is always a little bit tricky, especially people living so much longer. All right. Well, I think that's everything. So thank you guys very much for joining. Really appreciate it. Shoot me an email if you have questions, and maybe I will see a couple people this evening.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and/or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.